test, 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 test. Test. Okay, now I'm on this, right?
Yeah.
Very good, very good, very Okay, so let's get started, and hopefully a few more people will show up. Hopefully it's because of Easter that very few people are here, but now you're going to get all the attention, which will be hopefully good for you. We're also attempting to webcast this through YouTube, but I don't see anybody on yet. We'll see. Yeah, I can turn it up a little bit more. Hold on. How's this? Yeah, maybe a little too much. This is good. Okay, so let's see. There is one new person, right? Okay, so you'll need to catch up a little bit on Slack with the Workshop 1, Workshop 2 materials. And of those who are not new, have you all had a chance to look at these fantastic videos from Y Combinator? Have you, who hasn't had a chance to look at those yet, at these videos? Who's talking? Ah, okay. Okay, so, but they are really fantastic videos in my mind. Okay, very good. So if you haven't, please do so. Because those are what's going to generate questions that you can ask me here. So what I wanted to do today was for you guys to start practicing some of your ideas, either at the more sophisticated level or at the introductory level. So what I'm going to do is to start with the sophisticated level first. And let's see where that leads us. Let me log in here. And you should probably do the same at startbox.io. Who here has not watched this video yet? I know you probably haven't. Who else hasn't watched this video here? This video?
Hello, everyone. Thank you for visiting startbox.io. I want to give you a very quick explanation of what happens when you log in at our site. So first, I want to tell you what is not going to happen. Nobody's going to ask for your credit card. This site is 100% free. If you feel like it, you could put down James Bond for your name and james@bond.com for your email address, etc. We're not going to ask for a confirming email or anything like that. So feel free to use it in any way that you wish. Our recommendation is, after listening to this video, if you're intrigued, to click on this 5-minute test area, which is going to ask you for some questions about your venture concept. Company name, test, location, Phoenix, Arizona, which is where I am today. Our startup is in the software internet industry. We're deploying a business-to-business model. Our primary product is software. A one-sentence description of our business. I'll just enter test for now. 10% market share by year number 5 of our served market. We anticipate we'll have 2,000 customers by year 5, generating $2 million in revenue. Approximate value of our company at that point is going to be, let's say, $8 million. That's our hope. Our long-term gross profit margin is 85%. We currently have 0 paying customers, 0 cash on hand. We need an investment of, let's say, $50,000 to get to the next milestone. With this money, we'll deploy 50% in R&D, 30% in sales and marketing, and 20% for general and administrative. And we're willing to give up 10% of our company in exchange for this $50,000. We expect to start getting paying customers in 6 months, and we anticipate having, let's say, 50 paying customers by the end of our first year. So I click on Analyze, And what the system does is to generate a picture of the future, kind of a detailed picture of the future, including key financial outputs, key metrics, use of funds, income statement, balance sheet, cash flows, funding, projected cap table, etc. So this sounds almost impossible, as I can imagine you're thinking right now. But what we do is we take your assumptions and we look at benchmark company data from similar startups like yours in terms of industry, vertical, as well as business model. And we fill in some of the additional assumptions that are needed to generate the outputs that we're talking about. So now you can go back in and fine tune your inputs. You can do this by inviting some mentors, some co-founders, some investors to the platform, which then will enable you to discuss with them on a specific topic by topic basis the validity of your assumptions. So for example, I clicked this chat box under total available market. You can say, I think the total available market is such and such because, and an investor can come back and make some comments to you about that. And so each topic will have its own chat channel. If you don't understand what total available market is, you click on the question mark and a short video, 5-minute long video will come up and tell you about what total available market means. So after each time you change any one of your assumptions here, you can click on preview and get a new picture of the future painted for you. The red ones are cautions. You should look at things that are way outside of historical benchmarks more closely. Once you do the preview, you can click on Analyze and get a much deeper picture of the future that is more granular and more accurate. But the accuracy is dependent on the accuracy of your initial assumptions, as we mentioned. The system also allows you to do some what-if analysis, like what would happen if I change my number of customers versus exit value. And when you click on Analyze, you're going to get a graph of those two parameters. So if this is too complex sounding to you, you can choose to go the introductory way. And the introductory way is more qualitative rather than quantitative, but still prepares you for the quantitative part of the operation. Thank you.
Okay, so I know some of you may have watched this, but I thought it was important for you to see what we're talking about. So we can go in two directions now. One of them is the introductory route, and we can practice your venture ideas against the introductory assessment, or we can jump at this 5-minute test. So I'm going to jump over to the 5-minute test and try to explain to you what questions are we asking you and why are we asking those questions. And if you have access to a laptop, you can continue with me at this site with your own venture concept. If you don't have a laptop, then you can actually write down on a piece of paper the type of questions that we're asking and why we're asking them. So the first one, I don't know if you can all see this, but the very first line is company name, and I'm just going to put down test for that. For location, I will put down Phoenix, Arizona. So just raise your hand if you come across anything that doesn't make sense to you. So we have a distribution of backgrounds here. So anything that doesn't make sense, we will stop and assist you in terms of understanding what the question is asking for. So the third line is asking you, what industry are you in? What industry? So what do they mean by industry? Here is a whole bunch of, in bold, agriculture, construction, consumer, education, energy, entertainment, environment, equipment, blah, blah, software, media, real estate, services, etc., etc. Lots of industries listed for you there. And then sub-industries under each major industry. So I'm going to go very quickly around the room. The answer is going to be the name of the industry for your venture concept. And if you don't know, I don't know. So the name of the industry for you. Don't know. Industry? Nutrition industry? Hmm? Financial services industry? Space technology. Health insurance. Software. Healthcare. Mining. Healthcare. Food. Don't know? Okay. Say again. Property management, maybe on the real estate and a subcategory maybe. And do you have a venture concept in mind? Do you have a venture concept in mind that you want to practice with today? Healthcare, okay. Now the don't knows. Describe to us a little bit. Was that the Mexican food related one? No, that was somebody else. Okay, what was yours?
So mine is kind of like it's designed for mental health, but it would be more maybe fashion because we wear it.
Okay, so kind of wearable healthcare, something in that category, let's say, for now. And there was one other don't know. Speak up. Okay, so the idea is not gelled yet, so we don't have an industry. So we're going to pick an industry, and if you don't know, then you can pick an other, for example. But I will, for now, pick software internet industry. Now, why are we asking you what industry is your venture concept in? Because we have a database of previously successful startups in that particular industry and their performance characteristics. So we use some of that information, the average values that we get from such startups, and initially, at least, we apply them to your venture concept, assuming that you'll start off kind of in the middle of where these other companies have started. The next question that we ask is, what type of business model? And the options that we give you are business to consumer, business to business, and other. Can somebody give me an example of a business to consumer business model where the customers are consumers? Coca-Cola, perfect. How about an example of a business to business where the customer are other businesses? Salesforce, for example. Yeah. So who is the primary customer? Is it a consumer or is it a business is the question that we're asking. Now this applies to the paying customer. So for example, if in healthcare, this gets a little bit complicated. If the customers are hospitals, or if the customer is Medicare, or if the customer is insurance companies, in principle, it's a business to business sale, but the consumers end up benefiting. So who's paying? Josh is not here now, but he has an app for grocery stores. Who's the paying customer? It's the grocery stores. That's why actually it's a business to business model. So once you select that, I'll select business to business. Again, why are we asking you this question? Because we have data from other businesses, other startups that have managed to survive for 5 years or so, as to what type of metrics have applied to those types of companies that we're going to make use of. If you get stuck, so especially for those of you who are exercising this in real time on your own computers with your own venture concept, just stop me and yell out if anything doesn't make any sense at all. So our primary product is, the next one, is giving you several options. Our primary product is software. Our primary product is hardware, software-enabled hardware, service, and other. So software, probably straightforward, where you don't have a widget of any kind. You're just selling software to people. You develop the software and you sell a subscription to that software. For example, Adobe or Microsoft or Salesforce or anything like that. Hardware, you're actually building a widget and selling the widget. This microphone, for example. Software-enabled hardware, so it's a combination of software plus hardware, like a medical device, for example, that the hardware would not be useful to you if it didn't come with software. Service, where it's like a consulting firm, for example, where you're telling people what to do, generating reports, et cetera, et cetera. And then if it's not covered by any of these, click on Other. So I'm going to select software for my example here. Everybody with me? Let's see if there's anybody online. Doesn't seem to be. Okay. Following is a one-sentence description of our business. For now, I'm just going to say test. Now we're getting to a little bit more complicated questions here. So let me read the question to you. We assume that we can capture X% of our served available market in year number 5 or by year number 5. So we have some terminology here. The first one is, what is served available market that he's asking about? And what does he mean by will capture a certain percentage of that market? So again, if you watch the videos, this would be obvious to you. But the served available market is, first of all, it should be plural, served available markets, because in year number 1, you may be attacking just the Phoenix area. That's your served available market. In year number 2, Arizona. In year number 3, Southwest United States. Year number 5, all of US. So the market that you are putting all your resources into and attacking is the served available market. If you get an order from overseas while you're targeting Arizona, will you turn that customer down? Heck no. But you're not going to fly over to China to start selling in China because all your energy is focused on that served market. So what we're asking is basically for you to think about reasonably in 5 years, how much of my total available market, global market, how much of that can I reasonably attack? The lowest hanging fruit by year number 5, how big is that? And what % of it can I capture? Probably not 100%, historically speaking. So for example, a reasonable number might be, this is a target, right? So I'll say, I want to capture 10% of my targeted market by year number 5, 10%. So if I'm going stage by stage, year 1, Phoenix, year 2, Arizona, year 3, Southwest, etc., if I can't capture 15% or 10%, let's say, of the Phoenix market, then I shouldn't fool myself into thinking that I could capture 10% of the US market. So this is the idea about start small, demonstrate some metrics that you can extrapolate to your think big idea. So by year number 5, it may happen that you will be attacking, your idea is so good and you're executing so well that you're attacking the entire globe. You know, you have a software product and people are coming in from all over the place to buy your software product. So the served available market is exploding, which is fine. But first you have to think in terms of the beginning stages, what should I set as my goal for my served market by year number 5? Yes, sir. What if it's a new market? The question is, what if it's a brand new market? So the trick here is, I'm going to argue that nothing is a totally brand new market. So the one example that's always given is Airbnb, for instance. When they came out, it was a totally new market because there was no market of people renting their homes to others and so on. But there was some indication as to how many people were traveling and staying at hotels, what percentage of them might be willing to stay at somebody else's home. So some assumptions about, and then maybe, you know, would we start this in big cities or, you know, like in some corner of Iowa, for example. I don't have anything about anything any negative thing about Iowa, but people from Iowa might not be so willing to rent out their homes to passersby, you know. So some indication of what the market size might be. This is a living operation, as you will see in a few minutes. We're making some early assumptions as best as we can. The uncertainty associated with each is very high. Therefore, the picture of the future being painted is very fuzzy, not really believable. As we develop more and more confidence through customer discovery and these input variations, assumption variations are shrinking, the picture of the future becomes clearer and more believable. That's the name of the game. Okay, so any other questions to this point? Nothing mysterious, right? Even if you have never studied any business or any accounting or anything like that, just pure common sense is what we're after here. And this is supposed to be the hard, you know, the sophisticated version. So the introductory version is even simpler. Now, we're asking you for a think big question. By year number 5, we will have X number of paying customers. Difficult question. Many of us would say, I have no idea how many paying customers I'll have by year number 5. But this is an objective. This is an objective that you believe you can achieve, a number to put down there. So in my particular case, I think with our product, we can reach 2,000, we can have 2,000 paying customers by year number 5. Yes, sir. 5 years. In 5 years. In year 5, we estimate we will have, at that point in time, including repeat customers, 2,000 paying customers.
How about if it's in the case of a product that people might just buy once? Do they go to the step?
So if you don't have, so we'll capture those at the tail end. Right now, I don't want to complicate the inputs too much because I just want people to start creating a picture. And then we'll start refining the picture. And part of the refinement will be, is this a one-time sale or are you generating recurring revenue from your customers? If you're generating recurring revenue, what % of them are dropping out each year, called the churn rate, for example. But at the moment, I'm just asking, in year number 5, including return customers, including new customers, how many customers do you anticipate having in year number 5? So this is also a difficult question. Lots of uncertainty, no question about it. This is an uncertainty game because we're building a startup. By nature, it's a game of uncertainty. And again, I'll keep repeating this. Initially, the assumptions are uncertain, therefore the picture of the future is uncertain. As time goes on, the assumptions become more and more real because you're talking to customers and you're getting feedback. People are demonstrating that they're willing to pay $100 for your product and so on and so forth. So the uncertainty is shrinking on the inputs. Therefore, the fuzziness of the picture of the future is also being lost and is becoming a more believable picture of the future. The sad news is, many times, as the uncertainties shrink on the input, the output picture converges towards a death scenario. The company dies, the startup dies because your assumptions were incorrect. A few times, all the assumptions, as their uncertainty shrinks, the picture of the future converges towards a success scenario. It's your job to objectively decide, am I moving towards a death scenario as reality asserts itself in the inputs, or am I converging towards a death scenario? So 2,000 paying customers, and now another difficult question, but underneath this is a lot of information we're trying to get out of you. So presumably you wouldn't do this like in 10 seconds like you're doing now. You would spend a little bit of time thinking about it and then coming back to this. Because what we're asking you is, okay, if you have 2,000 paying customers in year number 5, how much revenue will those customers generate for your company? Now, some of the complications might be like, well, I have different type of customers. Some of them are paying a lot of money, some of them are paying a small amount of money, and so on and so forth. I don't care about those complications in the beginning at this stage. All I want is a total number here from all your customers. So generating X amount of dollars in revenue, and what I'm going to say for the venture concept that I have in my mind is $2 million in revenue from 2,000 customers. So my customers, on the average customer, yes, there may be some who are paying a lot, there may be some who are paying very little, but my average revenue per customer, my assumption is $1,000. Yeah. Year number 5, not cumulative, just year number 5. Not cumulative. Yeah, this is an important point. So it says in year 5, not cumulative from year 1 to year 5, but in year 5. So I'm assuming, I have to assume success. If I assume failure, then I shouldn't even start, right? So if everything goes right, as I'm hoping it will, then in year number 5, I'll have 2,000 customers generating $2 million in revenue. Complete guess at the moment. Hopefully, you'll generate $20 million in revenue, but we have to start somewhere, and we're trying to start with something that is reasonable, that's believable to you first. Beyond, trying to persuade anybody else, you first have to convince yourself that this is achievable. Yes, ma'am. Understood. Understood. So the question is, if you were working on something that you thought was patentable, would you first do the research on patenting the idea, or would you go through this exercise first? So my personal answer is to first think about the question, if we build it, will they buy? If we build it, will they buy? Before trying to spend money to build something, if you can't answer that question first, then you can end up spending and wasting a ton of money with patent attorneys and so on and so forth, and have nothing to show for it. So assume that the product can be made, because if we throw enough money at it, you can probably develop a product. Assume that a patent can be captured, and then will it make economic sense? Under those circumstances, would the company be successful? And what does success mean? Patent costs, let's assume for a good patent, let's say $30,000 you're going to spend on a patent. And assume you receive the patent, will the economic returns to the company far exceed that $30,000 to justify the $30,000 expenditure? So that exercise of assume we got it, what will people buy, and will it generate enough revenue for us? So for example, we get approached by people who have let's say a medical device in mind. And we have a very good sense as to how much it costs to get a product through the FDA. And if the market is not big enough to give us the type of return on our investment, no matter how good the technology, if the economics doesn't make sense, you're going to spend $1 million getting the product through the FDA, and the maximum profit that you will generate is $100,000 per year. If you build it, will they buy? No, they won't buy. So think about it some more and try to come up with some other device or some other approach. Very long answer to your question. Patents are very tricky, which could occupy another workshop. In fact, it will be in one of the series of videos that you listen to. What you have to be convinced is that if I spend the money to patent something, do I also have deep enough pockets to protect that patent when the big boys come and infringe on that patent? Are you able to spend $1 million a year in fighting a big boy infringing on your patent in court for 5 years? If you cannot, then you have to rethink whether this is a good idea or not. Usually patented consumer-facing things, when you have a lot of venture capital behind you where they understand that, yes, if somebody infringes, we're willing to spend $1 million a year for 5 years, then you may proceed. In my case, medical device, I'm sure I told you this before, we stayed away from patents because I knew that if General Electric infringed on our patent, I didn't have enough money to fight General Electric in court. So we just ran as fast as we could. We concentrated on a niche market that was so small for GE to be interested in. And we revealed all the inventions that we made in conferences to the entire public, because we did not want General Electric to patent something and then stop us from producing it. So we took a different approach where we revealed our inventions to everybody so that nobody could patent them, and thereby only whomever ran fastest would win, and we bet on ourselves to run faster than General Electric, Philips, Siemens, etc. So, case-by-case basis as to a decision about patenting. One more thing, and then I'll come to you. So, you go to an expert who's a patent attorney. And the typical answer from a patent attorney, hopefully there are no patent attorneys in-house, is, oh yes, we can patent this. However, during the entire time frame, I'll charge you $300 an hour for the work that I'm doing. So this is an inherent conflict of interest where if I persuade you to go after a patent, I'll make more money. And when I talk to my patent attorney friends, what they tell me is, I can patent anything you like. Just tell me how narrow to make the patent. Narrowness of a patent means its economic power is smaller. The narrower the patent, the less economic power. So you're giving up the economic power just to be able to say, I got a patent, and paying the patent attorney tons of money. So the situation of a patent, because it's so expensive, because it requires such deep knowledge about the patenting process and so on and so forth, I would approach it very, very carefully and talk to as many people as possible before you jump into the patent route. Sir? Okay. In some cases, for those of you who are maybe postdocs or something like this, or the invention is being made while you're in the employ of Arizona State University, then ASU decides whether to spend its own money in patenting something. That's a much better place for you to be. Then you take out a license for that patent that ASU paid for, and then pay royalties back to ASU for the use of that license. Any other questions? Okay, yes, sir. Yep, we're getting there. Okay. So we're getting there. There's a gross profit margin question coming up. Amin?
No, just for everyone, if you guys are looking for either a trademark or patenting something, the College of Law here at ASU does this for students for free. So as long as you guys are, I'm thinking about like the name of the company, for example, or your logo, or you have that you want to trademark, you can go through the College of Law.
Right. So let me repeat both of these things over the microphone here. The first one is gross profit margin that we're going to be asking about in a few questions down. What does it mean, and specifically, what does it mean for a software company, pure software company? And then the second one is for, let's say, the simpler legal questions of copywriting a logo or establishing an operating agreement for a company or articles of organization setting up a company. The law school offers free services for ASU students, faculty, staff. I have the email address of the person, so if you shoot me an email, I can give you the coordinates of the people who are involved in that at the law school. Yes, ma'am. So if either you have to have enough money behind you to enable you to fight, which means that the prospects of your patentable idea have to be so high that it's worth putting up a 5-year, $1 million a year fight against the big boy. Or if you assume that it will be very difficult for you to attract that type of money, which was the case in my case, it's better, in my opinion, to find a niche area where you're, again, I'm repeating myself, but where you're protected from above by how small the market you're targeting is. So our market was, let's say, the total market was, let's say, $50 million a year. That's not of interest to General Electric, Philips, Siemens. So I'm protected from above by their non-interest in what I'm doing. I'm protected from below, like copycats and so on, by the complexity of the product. And therefore, I can get away with not incurring patent costs and so on and so forth. So there's some, small tactics that you can use to reduce your risk and to reduce the amount of your own money that you put up on the line. If you're thinking about a patent, you generate something that's called a provisional patent. So what I did was, I thought I had a patentable idea. I downloaded a whole bunch of patents for similar products, understood the model, wrote the provisional patent myself, telling myself that I'm learning something new about writing patents, and then went to a patent attorney and said, I'm going to cap you at 1 hour, $300. Tell me what you would change in this provisional patent application. As opposed to like, I have a patentable idea and I'm open to you now. Take advantage of me as much as you want at $300 an hour. So this is kind of the street smartness that is necessary in a successful entrepreneur to find ways of reducing risk and reducing exposure and learning. Yeah. Any other questions? Yes, sir. So just to repeat that over the mic again, in case there's anybody online. So trade secrets, where a patent requires you to reveal how you do something. That's why you get the patent. You can keep that secret within the company and not get a patent. And then you would have to have very strong non-compete agreements with your employees so that employees don't walk away with the secret sauce. So there's always things to look out for, but luckily you won't be the very first ones to start a startup. People have gone through this and know mechanisms by which one can protect the company and the secret sauce. Yes, sir. You'll really have to yell though. So we didn't reveal our secrets, but we revealed things that we were afraid that some engineers at General Electric could think of, and then GE has enough money to patent it, and then we would not be able to implement that new feature into our product because of a GE patent, for example. So in order to prevent GE from patenting a new feature that we thought about, and to not spend a whole bunch of money trying to patent that feature, we would just send our engineers to a conference where they would say, and we are implementing this feature into our product. thereby eliminating the possibility of anybody else patenting it. The risk to us was then somebody else would incorporate that feature into their product also, but at least it wasn't the GEs of the world who would do it because of the niche market that we were targeting outside of the interest of GE. And we weren't so afraid of small competitors copying our features because we had tremendous faith in our brain power, our ability to run faster than them. So, tricky, no doubt, but I'm trying to find the best route in a very complicated, dangerous forest. Yeah, if you announce it publicly, then that information is now so-called in the public domain and therefore not patentable. Yeah. I'm not recommending it. I'm just recommending that you think about your specific circumstances, whether a patent is justified, whether the economic advantage is so high that, that there will be enough money behind you to protect and expand on that patent. So, need to think about it carefully. Okay, so now another tough question. In fact, a very tough question. And I think, some of these I need to modify, I can see already. The approximate value of our company in year five will be X dollars. Once again, I have no idea what the value of our company is going to be in 5 years. That is why benchmarks are so important. So, for example, the acquisition by Facebook of, I guess, Instagram, maybe it was, is like they paid $40 per user. Or when a private equity firm acquires a startup, in our case, when they acquired our company, there was a multiplier of profits for medical device companies, which is in the range of 15. So historically, medical device companies have been acquired for, growing medical device companies have been acquired for 15 times their annual profit. So when you start thinking about your own idea, you have to find some benchmarks of companies similar to yours that were acquired, and how much were they acquired for, and on what basis. So it could also be a multiple of revenue. So in my case, I'm going to say, based on my prior knowledge, that it's reasonable for me to be acquired at 3 times my revenue, or $6 million. I'm hoping to generate a company that somebody might be interested in buying me out at $6 million. There was a question back there, I think. Was there a question in the back? Yes, sir.
Multiple ideation sessions, we're trying to develop that concept more and more. At what point do we start saying, okay, oh, this is the idea, it's fleshed out enough that we need to start limiting what we talk about?
Yeah.
As well as consider submitting a particular patent. Because you were saying that most times we talk about the high-level concepts and not really delve into the secret sauce. But at what point do you know, like, oh, this is the actual secret sauce that we can't do?
Understood. So in a vast majority of the cases, the secret sauce ends up being execution. In a vast majority of cases, the secret sauce ends up being how good are the jockeys as opposed to the horse. In very exceptional cases, there is some secret sauce that is so unique that if somebody else copied that secret sauce, that you would be vulnerable. The cases in which that happens is a professor who's worked in his lab for many, many years and has received millions of dollars of funding to create a new pharmaceutical, for example, or to create a new medical device and so on, where really all that work has gone into the creation of intellectual property, and the execution part of the equation is now smaller than it would have been if it was a pure execution play. So I have a difficult time answering your question in a generic fashion, but it's a function of you assessing how much of our success is going to be determined by our ability to execute, and how much of our success is going to be based on our deep know-how about a particular topic. Yes, sir. Yeah, so for example, how much in grant money was spent in creating this intellectual property? In other words, like, you five of you thought of something overnight at home. Okay, probably 10,000 other people have done this also, and therefore the likelihood of having something patentable is very low. But if you have received to date, $5 million in federal funding, then presumably you have created some very specific intellectual property that may be worth protecting. And then the size of the market. If it's a very small niche market, the amount of expenditure associated with patenting may not be justified. In the consumer world where you're trying to sell it to, a billion people, then if you don't have protection of any kind, then profits are going to, as soon as you start demonstrating success, copycats are going to come in, your profit is going to shrink to zero, and everybody's going to be dead. So we don't want to be playing that game either. Okay, any other questions? So what we came up with is an approximate value for what we would hope that somebody would pay. So now you could say $100 billion. In 5 years, we're going to create a $100 billion company. And my immediate question to you is going to be, name 5 companies that reached $1 billion valuation in 5 years in the history of mankind. And you will not be able to, therefore that's not the correct number, right? Or, okay, they may be the correct number, but it's such an outlier that the probability of it happening is very, very low. If you come up with, we're going to create a company whose value will be $100,000 in 5 years, then my answer to you is, why don't you get a job instead? Then you will accumulate more than $100,000, hopefully, with your education over that time period, unless if you're driven by other things. So it has to make sense in both ways. Next question. So these are, by the way, how did we select these questions? These were the must-ask questions before we could put on top of these benchmark information from all other companies that we have. Benchmark companies that we have information from. So one of the questions that we have to ask you is this weird thing called gross profit margin. So what does gross profit margin mean? So without getting too technical about it, let me first give you by example. It's much easier to talk about it in terms of hardware. So if this is my product that I'm trying to sell, and I'm selling it for $1 each, and it costs me 50 cents to produce it, the gross profit margin is 50%. And how do I calculate that? It is price minus cost divided by price. So this is gross profit margin. Price minus the cost over price to produce 1 unit. Now, to get a little bit more technical, it's to create 1 additional unit. 1 additional unit. Why 1 additional unit? Because we want you to forget about, at the first layer of the onion, the cost of the equipment that you have to produce this thing, which may be extremely expensive. We'll treat that separately. All I'm talking about is on a unit-by-unit basis, sales price $1, cost to manufacture it 50 cents, therefore 50% profit margin. If it costs you nothing to produce another unit of a product, so Microsoft Word, let's say, And let's imagine that, they were just in the olden days when they were shipping CDs. What's the cost of producing one additional unit of Microsoft Word? 0, right? Because they have written the software and they're just putting it online and you're downloading it. Additional cost is 0. This is why, one of the reasons why software is eating the world, because the gross margins are so high. Once you write the software and you start selling it, an additional unit, the production of an additional unit is essentially 0 cost. And if you are onto something good, then it becomes extremely good. Whereas if you have to build a factory and then you have to buy components, some of you are probably studying supply chain, etc. You know how painful it is to create something. However, software companies, even software companies, have a cost that is proportional to the number of units being produced. And that is customer service. The more customers you have, one additional customer means you're going to increase your customer service organization a little bit more. So customer service accounts for roughly 15% of revenue. And therefore, even if you're a pure software company, you should enter 85% for gross profit margin. Because of the fact that gross margin attempts to capture costs that are proportional to your revenue, and customer service by definition is that. Others, for example, the size of your building or the size of the factory, the amount of equipment that you have, are also proportional to the amount of revenue that you're generating, but in a more stepwise fashion, whereas customer service is in a more linear fashion. X number of hours of people, customer service people, are required per new customer. Now, what else could go into the cost that is proportional? So, for example, shipping costs. If you're absorbing shipping costs and you tell the customer shipping is free, well, it's not free. Somebody has to pay for it, and it's you who's paying for it. So that would go into the gross margin also. For the lower the gross margin, the more difficult life is going to be for you, because everything else is going to eat away at that profit that you have on a unit by unit basis. You have to pay health insurance, you have to pay the engineers, you have to pay the cleanup, telephone, utility, rent, and so on and so forth. So everything is eating away at the revenue. So starting off with a high gross profit margin is obviously extremely desirable. If you don't know how much it's going to cost for you to manufacture your product, you're going to have to, unfortunately, guess. And initially, it will be a guess, and it will be a two-sided guess. One of them is the small volume production. We just need to produce 10 of these things. And at that point, the cost of manufacturing one is going to be extremely high. In 5 years, when you're manufacturing a ton of this stuff, it's like going to Costco and buying, whatever hamburger at Costco versus at Circle K. Economies of scale. The more of something you buy, the lower the cost going to be to you. So the gross profit margin is going to increase over time, presumably, because your costs are coming down. Going back to the fundamental of this, fuzzy assumptions. I have no idea how much it would take me to produce this. 0. So huge uncertainty. Now I went to 3 subcontract manufacturers in Arizona and maybe in China and India, and I said, how much would you produce this for me? And they said, one of them said 75 cents, the other one said 65, the other one said 45. And I took the mean value of those people who are used to manufacturing things of this kind. And now the uncertainty associated with that assumption collapsed. And therefore, that component of the set of assumptions that generate the picture of the future is now more clear. Therefore, we improve the believability of the picture of the future that we're generating. So stepwise improvement in better and better information. I received one quote from one subcontract manufacturer and he said 85 cents. So I put 85 cents, fine. Implicitly, you put 85 cents plus or minus 20 cents. And then you got two more quotes. Now it's 85 cents plus or minus 10 cents. We're trying to shrink uncertainty. That's the name of the game. We currently have a total of 0 paying customers. I'm just starting this thing off and I have 0 customers. Legitimate number to put down, no customers. And we currently have 0 cash on hand. So cash on hand is a fancy way of saying the money that the company has at its disposal to spend. So if this is an idea that you're thinking about, you haven't like committed any money, you can legitimately say $0. We have $0 cash on hand. Yes, sir.
Which means I'm not putting any of my money in the company.
I have not yet put any of my money in the company. The company has $0. I just want to see what's going to happen, right? So, yeah. We are currently seeking an investment of X dollars. Now, the important section, to get us to a next meaningful milestone. Next meaningful milestone. What could that be? So that could be, we're going to interview 100 potential customers. And we can't do that for free. I need to drive and talk to them and so on and so forth. Maybe buy lunch for them so that they will talk to me. Or I need to build a small prototype of what I have in mind, either software or hardware, so that I can show this to people. Any type of movement forward that enables you to reduce risk. So if these 100 people that you talked to, if 85 of them said, fantastic idea, if you had it today, I would buy it, that's a positive risk-reducing activity. So in the Slack channel, I keep asking, what are your key initial assumptions that need to be true for you to win? And then the next question is, how much money is it going to take to prove these assumptions to your satisfaction? And there you have to think frugally, not like nobody's going to cut you a check for $1 million just because you have an idea. They will give you a little bit of money to show us some light at the end of the tunnel, some risk reduction. So I will put down here for myself $50,000 to get us to a next meaningful milestone. And you can now spend some time thinking about what activity would reduce risk in the eyes of potential investors, future investors, and how much money would it take for me to execute on these experiments. The startup business is a hypothesis business. So you make a hypothesis, which we call assumption, and then you try to see whether that assumption is correct or not, and that requires expenditure of some money. Then if those assumptions come out to be true, you make a few more assumptions, and now you need some more money to execute to see if those assumptions will come true. Now, everybody asks us for money, 50,000, 100,000, 250,000, and because it's our money, we are pretty careful about where are you going to spend this money? And the easiest top level of the onion question is, which of these 3 buckets, how is the money going to be distributed into these 3 buckets? One bucket is research and development, engineering, that type of stuff, building the widget or the software and so on. The second bucket is marketing. Now, in our case, for a very early stage startup, it's more like customer discovery. So market research, let's call it. That's another bucket. And then the other one is general and administrative, which is, rent and everything else that you need to spend money on, kind of the other bucket. And we're curious to know how you will distribute this $50,000 over these three buckets. In my case, 50% is going to go to research and development related activity, 30% to customer discovery, which we're calling sales and marketing, and the remainder, 20%, is going to go to general and administrative. So you need to decide. You don't have to be like, 15.3% and so on, but is our money going to be used primarily for customer discovery? Is our money going to be used primarily for research and development and building a product? Or is our money going to go to, paying a CEO salary at $100,000 a year? I couldn't care less about paying a CEO $100,000. What I care about is results. So what is that CEO going to do? Build the product, which is then R&D, or do customer discovery, which is sales and marketing? But I don't want to pay for general and administrative, as little as possible, because that is not de-risking. Who here has never watched an episode of Shark Tank at all? You have not? Okay. Yes, sir.
Yeah, I was gonna ask, so as far as like software tools for the organization, let's say AWS.
Yeah. Yeah.
General administrative.
So AWS would be, because it's proportional to revenue, it could go under cost of goods sold, meaning into the gross profit margin part of things. Because AWS charges you by usage, and usage means proportional to revenue. So I would put AWS under cost of goods sold. By the way, for those of you who may not know, AWS is Amazon Web Services, where all your data is being handled for you by Amazon, and then they charge you a minuscule amount of money per data transaction that takes place on Amazon's web services. Fantastic enabler of software companies. So the Shark Tank question. We the founders, are willing to give up X% of our company in exchange for this investment amount. Critical question. You want $50,000 from an investor, and the investor is in it for you to become a successful company, and hopefully, at some point will be acquired for $6 million. The investor is taking a massive risk at this stage of the game because it's only an idea and nothing is proven, no revenue is generated yet. So from the investor's perspective, the question is this: I can give these guys $50,000 and it could completely disappear. There is no guarantee. We don't take your house if you fail to pay back or anything like that. It's a bet of $50,000. And why am I putting in this $50,000? Because if you get somebody to buy your company for $6 million, I'm going to take a percentage of that $6 million as a co-owner because you sold me part of your company for that money. So simplifying tremendously, if you say 10%, what the investor is doing is $50,000 investment. Chances of losing my entire $50,000 is maybe 80%. 80% probability that I'll lose the entire $50,000. But 20% chance that I will take 10% of the $6 million, which is $600,000. So do I want to risk $50,000 in exchange for the 20% chance of making $600,000? This is completely roulette. The same principle as roulette. If you bet on, black versus red, 2 times your money. If you bet on number 23, 50 times your money, but the probability of winning is much, much lower. So that's the question that they're gauging. Fear versus greed. Human evolution at work at this stage. Fear that I'll lose my $50,000. Greed that I'll make $600,000, small chance that I'll make $600,000. That's all that's going on in their mind. and it's captured in one single number and one single sentence, this: we're willing to give up X% of our company in exchange for this investment amount. Nothing magical, pure roulette rules. Any questions on that one? So I'm going to say, for $50,000, it depends on your circumstances and all that stuff, if you have the money or don't have the money, et cetera, but I'm going to say, I'm willing to give up 10% of my company for somebody who takes a chance with me and gives me $50,000, because if I'm successful, that person made me successful, and therefore I'm willing to give him 10% of the $6 million. I'm oversimplifying. There's lots of small complications that happen, like subsequent rounds of fundraising and so on and so forth. We'll capture those in future videos. Yes, ma'am.
So is that 10%, that's only if you're acquired, or they get
Right at that moment in time, I now own 10% of the company, and you own 90% of the company.
Does that mean of all your sales, they get 10% of your sales?
No. So investors they're not looking for interest or sharing in the profits. All they want in this particular game is for you to become a large company that'll be acquired by somebody for a cash amount, $6 million. At that point in time, I'm an owner, you're an owner, we're going to split that exit value amongst ourselves. This is what differentiates. Some of you are working on what I call lifestyle companies. So a lifestyle company is typically done to generate income to yourself. You really don't want or need investors. Or if you have investors, this is not the scalable technology startup game that Y Combinator and others are interested in. It's a different game. Typically, those investors may make a loan, and then over a period of time from your profits, you pay back the loan and so on. Because they're not in a lifestyle company, the expectation is not the acquisition of the company itself. So the best example here is probably Starbucks. So Starbucks could have been, one branch, mom and pop operation, exactly like what you would see in a Starbucks, and maybe making tremendous money for their owners of that particular branch. That's a lifestyle company. Or you build a Starbucks, first one branch. Wow, this is making money. It's good. Let's build another one, a second branch. And then let's franchise all over the Northwest. Then let's franchise all over the US. Let's go global. And maybe somebody will acquire Starbucks, or Starbucks will have an initial public offering and join NASDAQ or New York Stock Exchange. And all of our initial investors will make a tremendous amount of money on the money that they invested. So that's the primary difference between a lifestyle company and a scalable company. Not that lifestyle companies cannot be scalable also, but scalable in this sense is large scale, globally dominant company, like Google, for example. Any other questions? Yes, sir.
So they gave us $50,000, and then we do research, and then we figure out like, okay, there is no market in this, so it's done.
Done.
They don't ask us for the.
They don't ask you for anything back. That's the big risk that they're taking, investors are taking. So 50,000 is gone.
What if I just say like, I don't spend 50,000, instead I spend just 10,000?
Then ask for $10,000
No,
investment.
no. I'm getting 50,000, but I just spent 10,000.
10,000.
Let's just say
It's not going to work. So if you say it's not going to work, then the ethical thing to do would be to return the money back to the investors. Or the more interesting thing to do would be to figure out why that approach didn't work, and could we modify our thinking? And they call this pivoting. So, giving up quickly is not a characteristic of successful entrepreneurs. In the video you watched, like the best entrepreneurs are able to say, you're all wrong and I'm right. You're all wrong and I'm right. You're all wrong and I'm right. Oh, you're right and I was wrong. So at the right time, sticking to your beliefs as long as they make sense, and being able to accept reality when reality needs to be accepted.
No, I meant like the investors won't have any idea that how much I spend.
So they will have an idea, and good investors will ask you to give them information about, what money have you spent, what results have you achieved. It's really a partnership, and they're generally speaking in the business of making you win. They want you to get to that $6 million, and they'll do whatever they can to get to that 6 million. The typical nature of these investors is almost by definition, they're wealthy people. So they have a large wealth. And what they do is they divide their wealth into many buckets. So one big bucket is the safest investments like CDs and so on and so forth, some bonds, maybe the stock market. And then they have their philanthropic bucket and so on. And then they have one small bucket compared to the size of the wealth. That's for high risk, high reward. I know I can lose all this money, but who knows? Maybe it will become a Facebook and I'll make a ton of money. And they have a large portfolio of companies. Those are the type of people that you'll be dealing with. Any other questions on this topic? No? Yes? No? Okay. So, we're getting there. We anticipate our sales to start in N number of months. 8 months, 18 months, 2 months, some timeline to starting to generate revenue. Yeah.
About the one before. So say they have 10% of your company, you value it to be 6 million. Let's say somebody buys you for 20 million.
They still get 10%.
It's still 10% of the whole thing.
Yep.
not of the
Yep,
sales.
because they own 10% of your company, regardless what the sales price ends up being. Yeah, yep. Again, there are some nuances. We'll capture the nuances in subsequent videos and subsequent workshops. So some of you are knowledgeable about this area may say, well, that's not 100% correct. It's like 98% correct, but it's correct enough for our purposes today. There are exceptional cases where there may be terms in the investment. So for example, I invested $50,000. So this may be an interesting case. Special cases. I invested $50,000 in your company and now I own 10% of your company. The next day, somebody came and said, I'll buy your company for $100,000. And you said, great, because I own 90% of the company, so I'll get $90,000, and we'll give this poor slob $10,000 because he owns 10% of the company, even though he invested $50,000 in your company. So he made a big loss, $40,000 loss, and you made $90,000 as the founder. So to prevent situations like that, what a term included in the investment might be, first, you have to pay me back my 50, and then we'll do the 90-10 split. So complicating factors of this type, but we don't need to worry about them just this minute because those are not everyday things that happen. Any other questions? Yes, sir.
Now I give, like I own 100% of my company initially.
Yep.
Now I got 50,000 and I gave 10%.
Yeah.
Now if I need another 100,000 or so, if I need another 100,000, I'm saying to another investor, I'll give 10%. So my 90%, now I have 90% becomes 80%, or even his 10%
That's right.
drops.
That's right. So we call that dilution. I don't know why it's doing this. So we call that dilution. Each time the pie gets bigger, your portion of the pie becomes smaller because new people are putting in money. but the size of the pie, the objective size of the pie, is hopefully getting bigger and bigger also. Again, we will cover this in subsequent videos and subsequent workshops. Yeah, so, seed investment is followed by so-called Series A investment, Series B, Series C, and so on. More money is coming in constantly. But the hope is that that money is coming in at a higher valuation. The company is being valued much higher than it was when seed investment was coming in. So risk is being mitigated, and therefore the value of the company is increasing, and therefore $100,000 out into the future is buying a smaller portion of your company than in the very beginning stages of your company. I'll have a slide that will discuss all of that called milestone-based investing. But this is just for beginning, right? So we anticipate our sales to start in X number of months. So we have seen many companies die because they could not estimate this properly. So for example, my favorite example is if you have something that you want to sell to ASU and you say, I can persuade them to buy this thing in 6 months, most likely you'll turn out wrong because ASU will take like 18 months to debate and form commissions and to decide and then do a bid for everybody and so on. So the first sale comes in 18 months. Now you planned for 6 and the whole thing turned out to be 18. You have to put food on the table for those 12 months and you run out of money and the company dies. But if you better estimated 18 months, then when you talk to investors or to yourself about how much money will it take to get this train out of this train station, you will be much, much better prepared. So for my case, I'll put 8 months before we can generate any sales. And our first year of revenue generation, how many paying customers will I have in the first year of revenue generation? Remember, I said 2,000 customers by year number 5. So I'll say 50 paying customers in our first year of revenue generation. So what I attempted to do now is to come up with a quick and dirty set of assumptions that may or may not be believable. Why? Because I want to draw you into a more complete and possibly a little bit more complex structure where you can fine-tune this stuff. So now what we do is say, analyze. And when I click on analyze, what is this platform going to do? What it's going to do is to look up a whole bunch of more assumptions from similar companies like the one that you're proposing in a similar industry with a similar business model at a similar scale at a similar stage, and it's going to pop in those assumptions in addition to what you said. Maybe some of those assumptions you're going to end up disagreeing with. Maybe you'll end up disagreeing with even your own assumptions, but as soon as I click on analyze, you will get a picture of the future based on these assumptions plus the assumptions that we pulled in, and you will have an opportunity to change those in any way that you like and keep recreating a new picture of the future. So let's click on analyze and see what happens in this particular case. So I get a summary first. The terminology is slowly going to get a little bit more complicated. The first thing is, based on your assumptions that you have given us, and based on what we have seen from other similar startups, the investment that you will need is not $50,000, I'm sorry. You're going to need an investment of $200,000 based on those assumptions. So that's what that first line is saying. We calculated that 50 is not going to be adequate. You're going to need $200,000 investment. Unless if you change some of your assumptions, which we will give you the opportunity to do. Yes, sir.
Do you know what specific assumptions go into that number?
Of course I do. I developed the back end of this, but it's quite complex. There is like hundreds of variables that are coming in. But you're going to see in 2 seconds, kind of the correlation, not the equations, but the correlation between various inputs and outputs. Now, because the investment amount that you need is substantially higher than what you thought it would be, under these assumptions, you're not going to be able to get away with just giving 10% of your company away. Unfortunately, you're going to have to give 40% of your company away for the $200,000 that is needed. That's that second line. Founders' ownership percent after taking this investment is going to be 60%. Now, if that's unacceptable to you, then you don't have to do it, but that's what those calculations are saying currently with these assumptions. Not only that, but to reach your goal of getting to, ignore what I just said. So that's kind of the bad news. The good news is, based on the assumptions that you gave us, and based on other data that we've been able to pull from other startups, this company that you're describing to us has the potential to become not a $6 million company, but a $10 million company. Because of the number of customers that you're projecting, because of the revenue that you're projecting, because of the gross profit margin, because of how other such companies have been, how much other companies have been acquired for, etc. This can be a $10 million company. And an investor who takes this bet of $200,000, if you end up with a $10 million exit, is going to make 12 times their money. I'm going to pause there for a second without complicating things more for you at this stage. But the essence of what I want you to absorb right now is you made some very simple assumptions. We secretly went back and pulled up a whole bunch of additional assumptions and put them all in one place. And we cranked out a picture of the future for you that includes a summary, key financial outputs, key metrics that are important to investors in your industry, how the funds are going to be used, and 3 statements that every investor wants to see. One of them is called an income statement. The other one is a balance sheet. The third one is a cash flow statement. And I'll talk about this in just 2 seconds. Funding needs, capitalization table, meaning who owns what. So we generated this entire detailed picture of the future for you. What we didn't want to do is the following. We want entrepreneurs to be entrepreneurs. We don't want to turn you into accountants. We don't want to turn you into financial experts. We don't want to turn you into Excel experts. All we want from you is, what are your assumptions and can you defend these assumptions? Then we let the computer do the crunching of creating the type of accounting documents that any investor would want to see, but provided you can defend your assumptions, the more defensible the assumptions, the more defensible your outputs. Now, a couple more things here. At this point, things start getting a little bit more complex. So now we go to the input page. So this is back to inputs. These are the inputs that generated the picture of the future that I just showed you. And these are the key metrics and benchmarks that were used to support your assumptions. Now here is what happens. You hopefully will end up having some mentors, some co-founders, some potential investors. You're going to click here, invitation management, and write their email address and invite them to come and work with you on this platform. And what they will do is they'll say, for example, total available market of $133 million. How did you come up with this? You will click here and say, I came up with $133 million by the following arguments. And then the investor is going to come back here and say, well, I don't buy that argument. I think your total available market is such and such because of such and such. For each of these assumptions, there will be a discussion between you, your mentors, your professors, your potential investors. For each discussion point, like annual churn rate or 50-year market share, each one will have a series of discussions, the end result of which is going to be, okay, well, maybe we should change this number from 10% to 15% in the beginning and then declining down to 5%. I'm convinced of this. And each time you make a change in these assumptions, you click on preview, and it will paint you another picture of the future based on the modified assumptions. Until you and your potential investor are satisfied with the assumptions at this point in time that we have put into this platform. Now then, this becomes a living document. What that means is you put year one assumptions like number of customers, for example. Year one, 50, 120, blah, blah, all the way up to 2,000. Well, year one passes, and you only received 5 customers. So now you use this platform to change this to 5, and now a jump from 5 to 120 is totally unreasonable. So you reforecast what these numbers might be in light of reality having asserted itself in year number 1. You with me? Or did I lose everybody here? So this is a more sophisticated, in my opinion at least, I shouldn't say sophisticated, a more complete approach than what you may have seen, which is like business model canvas and so on and so forth, and a whole bunch of words and so on. The purpose of this is to leave you no place to hide. The purpose of this platform is to leave you no place to hide. 100-page business plan that nobody reads gives you lots of places to hide. Blah, 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 blah. Whereas numbers and defense of those numbers and a discussion of each of those numbers by people who understand that particular area well is a much more robust means of painting a picture of the future than just dreaming. This is the essence of what we're trying to achieve with this platform. So I admit it is complex, lots of moving parts, but that is what happens in real life. In fact, this is just a tiny piece of how complex life gets once you decide to launch a company. The type of equations that are going to go in your head is, well, I got a whole bunch of upset customers. Should I hire another customer service person to reduce the number of upset customers? How many of these upset customers are leaving my company and therefore reducing my potential profit in subsequent years versus how much will I have to pay an additional customer service person so that these people won't leave and my profits will still stay up? Times 100 is what's going on in your mind as a founder every day, every living second. This tool gives you a feeling of how those are going to take place. They're all incorporated, like churn rate is how fast your customers are leaving you. Cost of goods sold for customer service is an expenditure that you include here, and so on and so forth, and benchmark it against other companies. So I'm personally a much stronger believer in this platform than, say, business model canvas. If you want to do business model canvas, do business model canvas. I don't care. It's, I don't have any preference really in terms of dictating to you what you should be doing. But this has turned out to be very useful to me if you're serious about it. The way to move towards this level of seriousness and this level of granularity is through the introductory channel of this platform, which is what we're going to take a quick look at after taking a 10-minute break. Okay, so let's take a 10-minute break and then come back. Okay, so we'll get started with this now and do essentially a similar thing, but in a much more qualitative fashion. So this is the introductory channel of the same platform. Once again, we'll deploy the same approach. Title of innovation, I'll say test. Contact name, Emre. Contact email, test@test.com. Contact phone, 555-555-5555, which is where you can not reach me. Test, location, Phoenix. So now we got field of innovation. So we're not asking for industry, we're not asking for business model, because this is by definition the introductory version. And so we have several, I don't know if you can read it from back there, general, something called dissemination and implementation, which you don't need to worry about, but this is what's paying the bills for this platform. We have a grant from the National Institute of Health, and they're interested in this magical thing called dissemination and implementation. So don't worry about it unless if you're curious. Medical devices, diagnostics, therapeutics, social entrepreneurship, online marketplaces, ready for VC, ready for venture capital, another flavor of the same thing. And by Eli, are you serious or are you just playing? These are the sets of questions we have so far. You can imagine adding more of these, like social sites or any other thing that you can really imagine. We could put this down a long list of areas. So for the purposes of just getting started, we're going to pick general. So not quite ready yet. We're just trying to decide what the heck we want to do. We would like you to put up here either a pitch deck or an executive summary, something that describes to us what your innovation is about. And the fundamental approach of this introductory package is the following. We're going to ask you a bunch of questions, and you're going to give us some answers that you pick from a drop-down menu over here. And the system has a backend, just like the other one did, where we will then give you a score, a viability score. Based on what? Based on your self-assessment of your venture idea, because you're picking the answers that you're giving. So that's why it's a self-assessment. And you will be assigned a score that ranges from -100, miserable idea, to +100, well, it sounds like a really good idea to you, because it's a self-assessment. Each time you tell us an answer, you're supposed to click on the chat box and tell us why you selected the answer that you selected. So you finish this and you'll get a score, and then a domain expert is going to come in and answer the same questions based on the information that you provided them here. They will have the same drop-down options, and at the end, you will get an assessment score from a domain expert. And what hopefully will be interesting is, where do the scores of the domain expert deviate the most from your assessment, and why? Because the domain expert is going to come here and tell you, no, I don't believe what you said because of such and such. So you will get different types of assessment scores from different domain experts. They probably will disagree amongst themselves also, but you will have an opportunity to compare your assessment of your idea to those of others who presumably are more experienced in that area than you are. If by itself, if you run one idea here and you get 48, doesn't mean anything at all until a domain expert comes in and gives an assessment score of 87. Now you're onto something interesting to dive into. The other use of this is if you have 7 different ideas and you don't yet know which one you should focus your energy on, it may be a good idea to run all 7 through here and to see whether there's an outlier in terms of this self-assessment score or in terms of better match with expert scores. So by themselves, the number that you get, I wouldn't pay too much attention to it, but the relative scores among your ideas and relative scores with experts is valuable to you, I would argue. Any questions, any confusion about this before we start the test case? So for those of you who have computers again, you can get to this site with a venture concept and start filling this in. For those of you who don't, you can keep a piece of paper and just jot down what are the questions that we're asking. So the first question that we typically ask people is the following. If you can't read it from here, how deep is the customer pain or unmet need today that your innovation may solve? So we're always interested in fulfilling an unmet need. Therefore, it's your obligation to tell us what unmet need you're trying to satisfy and how deep is that unmet need. So here you would explain to us what is the unmet need and how are you fulfilling, not how are you fulfilling, and how deep is that unmet need. Because there have been cases where there wasn't a big customer pain when the company just got started, or there wasn't a huge unmet need, going back to Airbnb, for example, people were not clamoring for beds. We ask you to justify how big could the customer pain or the unmet need become in the future. So give you an out in terms of like creating something from nothing, a defense of, well, today there isn't one, but tomorrow they could be one because. So for each of you then, those of you who have a venture idea in mind, the depth, not the extent, because we're going to ask you how many individuals are impacted. Not the extent, but the depth of the customer pain and unmet need. And the options that you have are extreme pain, moderate pain, not much pain involved, hardly any pain at all, mostly a market opportunity. So in my case, I'm going to select moderate pain for the idea that I have in mind that I would describe here also. And the score starts moving. When we finish with it, we'll get a final assessment score. Any questions on the customer pain, unmet need, and the depth of it?
So the 7 questions change depending on the field of innovation.
That's correct.
Are we all supposed to go to general?
You don't have to. So the question is, should we all today sitting here go to general? Or can we go to a specific area that is related to us, like online marketplaces or ready for VC? My recommendation to you is stick with the general in this workshop and do your specific area at home so that if there are any questions raised, you can apply these. And these are kind of common to all startups, so you might as well answer these also, in my opinion, but you can do anything you want. You're not getting a grade or anything like that in this workshop. You had a question.
What if there is no problem now, but I predict that it might become a problem in the future?
So I would indicate that in the chat box and then select the drop-down menu option that relates to your prediction for the future. Yep. And then see whether an expert or a person who has money to invest agrees with your projection or not in the chat box again. Okay, so the next question is number of, and these are verbose, right? Lots of words. Unfortunately, to make it as clear as possible, we had to use a lot of words. Number of impacted individuals your innovation might impact by year 5 of the implementation of your innovation. Long way of saying how many people are suffering, who might be willing to pay for your solution, when they presumably already have many other alternatives to resolve this pain. So we're kind of forcing you to think about not everybody is going to jump and start paying you for a solution because there are other solutions available to them. And so when you take that into account and you assume, 5 years have gone by, how many people can you convince to buy your product or service? And this is the main difference between the more complex version of the platform and the simpler version of the platform. Here we say millions and millions, hundreds of thousands, thousands will always be a very small niche. Whereas in the platform, you're supposed to tell us there's 450,000 such people in the United States. So this is basically preparing you for the more complex version of the platform. So number of individuals, and here the underlying theme is that people are more attracted to larger markets than tiny little markets, but not always the case. So here again, you would say, well, I'm in a niche, but it's a beautiful niche because people will be willing to pay a very high amount of money to us who have this particular pain. In the realm of pharmaceuticals, for instance, there is drugs called orphan drugs, where let's say only 5,000 people suffer in the world from that particular ailment, and the cost of the pharmaceutical is hundreds of thousands of dollars per year, and there's a big move towards these orphan drugs, for example. So your explanations are always important. For myself, I'll pick hundreds of thousands. Next one. Any questions on the extent of the pain? So we have the depth of the pain and the extent of the pain. And you have to indicate, again, I want to emphasize this difference between lifestyle and scalable. Even if you're thinking about a lifestyle company, to make best use of the platform in terms of like educational outcome, you should force yourself to think about what if it's very successful, can it be scaled? If the 2 places that I set up are very successful, and if I scaled it. So basically, this think big part is what anytime we say year 5, think big. Anytime we say year 1, start small. Year 5, greed. Year 1, fear is the driving force. So next one, your solutions, price, performance, compared to the alternatives already available to your potential customers today. Price versus performance. So the options are infinitely better price performance offering, far better, about the same. So you pick one of these options for yourself and then defend it in the chat box. Don't know is always an option too. Then you're kind of saying like, help, I don't know the answer to this, and somebody will come and help you, hopefully. So, you can pick far better for me. You pick whatever makes sense to you as long as you can defend it. Can your venture one day become a large global enterprise with many lines of products centered around a core competency? I'll come to you in just 2 seconds. So this is an important question. One of the things that you will often hear is a single product does not a company make. In the way we're thinking about scalable companies, meaning like QVC or some of the things that you see in Shark Tank, some widget, okay, you invented this widget and you're going to build a company around it. What we're much more interested in is this term core competency. If you build a competency with your co-founders, something that you really know how to do, then the sky is the limit. You can deploy that competency at different areas that you understand and create different products be able to understand what customers are making, and you can create an enterprise, a growing enterprise. Whereas a single product that you thought of one night doesn't lend itself to such success. So this is forcing you to think about, can you create a competency that you will dominate and own and bring people together that knows this area so well, technically, otherwise, customer understanding wise and so on, that the product is secondary. It's the competency that matters. So an answer to that question is what we're looking for in question number 5. Those are the ones that we want to bet on, not the one single cute product that you came up with. I mean, you forgot or yeah.
Is it the product the way you envisioned it, or in 5 years? That's better or worse?
Is it so? Which one? Number 4 or 3? You're so the way you envision it for the long run. The way you envision it for the long run. So let's see. I got lost a little bit here. Did I jump one or what? I think I jumped one. So core competency and an enterprise. Once we get some initial, no. Boy, I'm really goofing up here. This one. Once we get some initial traction, easy to scale up, somewhat challenging, can be done, difficult to scale, extremely difficult to scale our venture up to such a level. Pick one. Now, the one that I jumped over, unfortunately, I apologize. Is it possible to produce your product or service, and again, I mean, this is in the long run, at a competitive cost so that you can build a sustainable venture? Competitive cost so that it can become a sustainable venture. What does this mean? What this means is, again, those of you who may have read Peter Thiel's book, 0 to 1, that's posted under the resources, he basically says, unless if you can generate a monopoly like Google, you may be wasting your time. Like the idea should be to create something that dominates so heavily and generates such massive profits that you can then be able to do good. Like Google is a fantastic place to work and does all these, tries to do good things and so on and so forth. But imagine a company that's always under competitive pressure and always fighting, always trying to just survive rather than the luxury of Google. Even if your objective is to generate positive impact, it will be much more difficult to generate positive impact when you're fighting for your life every day, as opposed to dominating an area so hard that you create all this luxury for yourself. So this question hints at a competitive cost, meaning, can this company be a profitable company so that you can not only survive but thrive? Question? No? Okay. So that's the essence of that question there. And again, most scalable software companies lend themselves to costs permit extremely high profits. Nothing to be embarrassed about here in the sense of how Peter Thiel is thinking about this, meaning those companies that are fighting for survival are much less likely to generate positive social impact than those that can generate extremely high profits. Controversial, I know. Peter Thiel on purpose is controversial, but something for you guys to think about. Whether you agree or disagree, up to you. Number 6, how easy would it be for other knowledgeable people or companies to copy your venture concept particularly if you start showing some success in the market. So again, we try to pick these words carefully. You start showing some success in the market, and there's lots of sharks. There's lots of sharks with access to money. There's lots of sharks with access to money and to brain power. So they will say, wow, this company is making money. We better get into it too. And we'll offer it at a lower price. And then another one, and then another one. As I mentioned in a few minutes before, all of a sudden profits are disappearing. Everybody's eating each other's lunch and everybody's dead. So what is the probability of that happening to you? It would be extremely difficult for another team with our capabilities to come together and to do what we're doing, or extremely easy. I used to say when we had our own company, if anybody is crazy enough to try to duplicate what we did, they're most welcome to do so. It was that difficult. So I'll pick extremely difficult in my case here. Any questions, comments on this one? So what I'm not doing is giving any kinds of explanation here, but that's the whole purpose. You're supposed to defend yourself and then listen to what others are saying to your defense. Let me pause here for 2 seconds. Slack and the workshop is not working as well as I was hoping it would work, which is, this is a cohort. I don't know everything by any means. If there was much more interaction amongst you who all want to be entrepreneurs and who have been sticking with this workshop, to post these and then to invite people to come in and to comment on your idea, and they did so. And if we had a very active communication channel amongst you and amongst those who didn't show up to the workshop but are still on Slack, it will be far more effective than putting these in. And I get an indication each time somebody has a question on the chat box. I could spend 80 hours a week just doing this, but that's silly, right? Just in terms of the use of my time and also not deploying the power of the crowd. You know a lot yourselves too. So basically encouraging you to identify people that you would like to get engaged with in this class, and to use the invitation tool to invite people to your platform and to discuss these on Slack, if you can. Okay. How many other companies are there out there that already provide a viable alternative to the solution you're proposing? So in angel investment group meetings, this is a primary area of complaint. Not enough discussion on competition and alternatives. YC question, I think, is who keeps you awake at night? Who are you most afraid of? That area also you need to take a deep dive into that area of alternatives. So saying, we have no competition is a very weak thing to say, generally looked down upon, because the interpretation is alternatives. And so the options are only a few startups, a few established companies, none, many. None and many, so many is scary, but to us, none is also scary, because how come nobody else has gotten into this? Only a few startups is probably better than none, because this provides a little bit of validation that there's other people who have seen what you have seen. So I pick for myself this one, you pick whatever you want. They did a study, number 8. They did a study of what correlated the most with startup success. And the number one thing that correlated with startup success was timing. Not too early, not too late. If you're too late, you're a me too, ME-TOO, nobody cares. And if you're too early, Then we invest money in you, and the idea was great, but boy, if we had waited for 5 years before making an investment in this, we could have made a lot of money, except what we did was to took a machete and opened up the pathway in the jungle, and then a guy came from behind us with more money and with more knowledge and wiped us over. So this first mover advantage sometimes is not an advantage. It's a suicidal path. So Goldilocks, not too early, not too late, just right, perfect timing, and here is why. So if you can say to yourself, I know somebody will do this in the next 5 years. There's no question in my mind that we will be using this type of product in 5 years. It may not be me, it may be somebody else, but it will happen. You're in a good state. If you say people are already beginning to do this, that's also good, depending on what type of people, with what type of venture backing and so on. This is a hot market. A lot of people are moving into this. Now you're getting into the dangerous zone. And then maybe too late, lots of people are doing this, would be not so good. So here's how Peter Thiel starts his book. What truth do you know that most people disagree with? What truth do you know that most people disagree with? If everybody agrees with you, presumably you're not onto something that's good. Like, I know that there's some social entrepreneurs here, but like yet another well in Africa to provide water to a village. Everybody agrees that's a fantastic thing to do. And he sees that as a weakness. What you need to come up with is an idea where there is some people who are going to laugh at your idea and say it's ridiculous. And then a much more smaller group of people who say, well, maybe it could work, and you yourself believe that it will work. Those are the type of areas that you want to focus on, according to Thiel. Is there a reason for your customers and yourself to be passionate about your venture concept? So this is the difference between I became an entrepreneur to get wealthy versus I was driven by something larger than getting wealthy. And by larger, I don't mean more lofty or anything like that. It may be like a psychological defect that you have that is driving you, but there has to be something that's driving you, like a chip on your shoulder would even be good enough. So everybody should be passionate about this. It's that important too. Not really, it's just another way to make money, kind of the extremes. Many people are passionate about this, etc., etc. So you select your option. Why is passion important? Because the agony associated with entrepreneurship is so incredibly difficult that if you're just out there only because you want to make money, you will probably give up at some level of difficulty that you're going to face. And in fact, some of your co-founders, some of your employees, the difference between you and them is going to be at what point do you give up versus them? What is your conviction level and clarity of thinking? So the example that I gave, the successful entrepreneur has such clarity of thinking that is not swayed by majority opinion. So you're all wrong, I'm right. I'm convinced I'm right. You're still wrong and I'm right. And then at some point, okay, I see the argument, I see the data, I see reality. I think it's time for us to switch. So not yielding to majority opinion is driven from passion, I think, and belief. Another question, how easy will it be to put together, not out together, put together a team of experts to design and build your innovation? Super, super difficult for most people because there is so many aspects of excellence that is needed to build a successful startup. And in fact, most people struggle with this the most. I was talking to somebody the other day and I was saying, I don't need average people. I don't even need above average people. I need freaky outlier people in order to build a company. Otherwise, it's just not going to happen. They have to be scary good, not just, fantastic, great, and so on and so forth. And that's incredibly difficult to do. So you have to be always on the lookout for talent. Some people argue that it's winning at the entrepreneurship game is winning at the entrepreneurship game is dependent on your ability to detect extreme talent and to recruit extreme talent, because that's what you're going to leverage to do this multiplier effect of multiple extreme talent. 1 + 1 = 5 type of situation is what you need to create if you want to build a large successful organization. Questions? Comments? Yes, ma'am. The last one, you mean? So that's your team I was talking about. Because you're going to have, some technical people, some people who are able to sell, some people who understand user interface, user experience. You really have to have a few superstars on your team who are ready to bleed for the company. Not so much on the customer side. This particular question is asking whether you have any hope of building the right team. Do you feel confident enough that you could detect talent and to attract talent? Sir?
What are the ways to make them stay in our company?
Yeah, so, human psychology, people need at different stages of their life, but it changes a little bit at what stage they are in their life. But people need, I think, respect, recognition, admiration. Those types of things are much more valuable in its essence than how much money they're making is important too, but they will not tolerate not being respected, but being paid a bunch of money. My specific example that I may have given to you guys is I stole a tremendous chip designer, solid state circuit designer from Intel Corporation, which would have been impossible, my dink little company stealing a tremendous designer from Intel. The only reason why I was able to do so was that this individual was an immigrant from Vietnam and had a very thick accent. So it was very difficult to understand what he was saying. But my team, assessed him as, not to pat ourselves in the back, but at our level of performance and intelligence and so on and so forth. So what I was able to tell him was, if you want to work with people who only value your brain and they're at your brain power level, and you will be communicating with them and they couldn't care less about your accent at all, you should come work with us instead of with just a tiny little cog in the Intel machine. And I was able to hire him at a much lower wage than what Intel was paying them, because what he wanted was respect. So, psychology, human psychology. Yeah, we're all driven by evolutionary forces, Yeah, money was not one of them. How easy will it be to put together? Okay, let's see. How easy will it be to demonstrate a simulation of your concept before you actually build it? So what we're asking here is that question that I asked you: if you build it, will they buy? What is your confidence level that if you build it, they would buy before you build it? So the weaker the argument is here, the more dangerous it is for you. So for example, I was watching one of the videos that you're supposed to watch too, I think, was for Dropbox. The first minimally viable product for Dropbox was a video describing what Dropbox could become. So that's a simulation of the future that they're using to test to see whether if we build it, would people buy? So those types of experiments you have to do and have to convince yourself that you can demonstrate that if you build it, they would buy. Can you think of any initial arm's length customers who may be likely to buy early on before your full product or service is complete? Arm's length meaning, not your aunt and your uncle, but other people. And crowdfunding is a very good way of testing this, which I recommend to many of you here, as particularly if the product is sexy enough for crowdfunding. It's like a pre-sale and a great way to find out. So this would be a big, would make a big difference in the assessment of your venture concept. Are there any established companies who might see a benefit in partnering with you on your venture concept? This is also an important question, but it's a real one. We see in angel investment presentations lots of logos of big companies, and they've talked to one salesperson here and another salesperson here, totally meaningless. Is there any tangible established company interest in working with you? Is there anything in it for them to work with you? The stronger that argument is, the higher your score is going to be. This won't apply to too many of you, but are there any government grant funding possibilities for your venture concept? This is maybe for you, where the government is putting in billions of dollars into technological innovations to improve technological development in the country. And if you have an innovation that fits into any government agency, defense, agriculture, transportation, health, you name it, then they by law have to reserve a certain percentage of their budget to this program. Not a loan, just a grant, not equity, called SBIR. Everybody should go after this if it applies to them. National Science Foundation is kind of a catch-all. If you think nothing else is fitting, you should consider the National Science Foundation as a source. Oops. And then how likely is it for your company to be an acquisition merger target of a larger, more established company within the next 5 years? So when we started our own companies, I had always in the back of my mind who's going to buy our company. And it was always about cultivating potential buyers of my company because that was the end goal. And so at any time, almost like in year one, I could have told you with some clarity, these are the companies that I think might end up buying us. And we constantly kept going for them. So my selections ended up in, very good question, I'll get to that in 2 seconds. Got a score of 89%, who cares? But when I expose it to knowledgeable people like other investors and so on, and I explain to them what my concept does and why, if I get an average of 43 from investors, then I have some thinking to do. Maybe I'm dreaming a little bit and I'm not explaining myself well enough, and so on and so forth. And then if I was a beginner and I put in 6 other venture concepts here, and this stood out at 89 and the other ones clustered around 50, then maybe I should pay a little bit more attention to this. So someone asked a great question on Slack. This is all checking out the horse, but we keep saying it's all in the jockey. So what have people done and what can we do to predict the success probability of a jockey, meaning a first-time entrepreneur? We asked that first-time entrepreneur or a group of founding team members a bunch of questions, and then based on history, we assign a probability that this person can do a great job as an entrepreneur. So I'll tell you from my personal experience. I was at Washington University, and this freshman would come and talk to me. He wanted to be an entrepreneur. And basically, I told him, I'm going to invest $100,000 in you, and I don't care what company you start. So I wrongly or rightfully had this impression, intuition of being able to detect the type of characteristics that I was used to seeing anecdotally from successful entrepreneurs. I've talked to several, maybe 3 ASU students out of the hundreds that I've talked to so far, where I could make a similar statement. I'll invest $100,000 in you, and I don't care what you do. Just remember me when you have your successful startup. What I'm trying to say is this is still a fuzzy art rather than a science, but anytime individuals claim the ability to detect something and they can prove it, that their hit rate was high enough, then I think there's a role for the computer to play and the data to play and so on and so forth. So we're in the process of coming up with a set of questions that we will ask founders, kind of like a personality test type of thing, to tell us whether we could have any predictive power over identifying successful entrepreneurs. When I went to Y Combinator for their angel investor training session, they brought up one very experienced super angel who said, his hit rate, selection hit rate was something like 80%. And when they asked him, how the heck do you do this? It's impossible. Nobody does, 80% hit rate. He said, well, I've been doing this for so long, and he was an old person, older than me. He said that, I've been doing this for so long that after like a 20-minute conversation, I know if this person has it in him or her to do this. And so my engineering mind says I can copy that guy's know-how and plant it into the computer and have some predictive algorithms. At least it's worth trying. I will send out a survey that we have for founders on Slack that you can fill in. We don't yet have any data to make any predictions, but at least it will be interesting to see what type of distribution we will get about this. If you watched How to Build a Product #1, the founder of Reddit, when you listen to him, he is one of those. If he had not founded Reddit and he was just a guy off the street I was talking to, I would have said, okay, this guy has it, and I would have made that, I'll give you $100,000 and you do whatever you want. The other guy on that first video was a little bit more not quite the right fit, and I can't even explain in detail what was the difference between those two that created that type of impression in me. And my wife was listening to them, and she was saying they're so detached and unemotional and like this, on the spectrum, right? A little bit of Asperger's type of behavior, which enables people to focus on one thing very hard and very carefully, seems to be a characteristic of entrepreneurs. And we were discussing, if those are the successful entrepreneurs who are more comfortable with technology than people, what are the implications of that overall? If those are the ones that are going, like Jeff Bezos and Bill Gates, as he gets old, he gets a little bit more humane, I think. But Bezos, for instance, you can tell if you look at him, he's a machine person, like those guys seem to be the winners in the game, and we'll see how all that turns out. Yes, ma'am. So actually, we, generally speaking, like companies that have raised Kickstarter funding because it demonstrates the hustle nature of the entrepreneur creating something out of nothing. Two, it's a pre-sale that's indicating that there is interest for the product. People are pre-buying it essentially. That's what Kickstarter is. And there is now especially a certain level of competency that is required to generate a sexy enough video and so on and so forth, and some persuasion capabilities, which are going to be so important for the entrepreneur. So we are not too concerned about, it depends, right? So we're not too concerned about whether a Kickstarter campaign is going to erode your intellectual property rights or whether people are going to copy you because they saw you on Kickstarter. Because we're big believers that execution is 95% of the game and the protection of the idea itself is just 5%, with some exceptions where big science is being deployed, is being commercialized. Any other questions? Any other comments or suggestions? So I'm trying to decide whether I should be disappointed or not disappointed about the drop-off rate for the physical attendance. I think we started off with 200 signups, 170 on Slack, then 75, 35, and I count 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 21. So 20, half-life every week. It's getting reduced by a factor of 2. Part of me says, I don't care, even if it's like the last 5 people, hopefully those last 5 will be the type that I say, okay, you're it, you know how to endure. And part of me says, is it something that I could change to keep up the attendance levels? And then whether it's energy well spent to pull people in, kicking and screaming, to drag them into this, because they won't be, if you pull them in kicking and screaming into entrepreneurship, most likely they will not be successful entrepreneurs, so why waste time? But if you have any ideas, I'm all ears. Right. So what I'm thinking about is maybe if I repeat this workshop series to make it all online, but part of me thinks, and you need to guide me, is that this type of conversation face-to-face has some value too. If you push everything online, the nuances are not going to be caught, maybe. I don't know. But I agree with you. I mean, that's an advantage of the flipped class model and a disadvantage. Do everything yourself, and it's just as easy if we had recorded this, just watch me do this, and so why show up? I think he had his hand first up. Yes, sir. Yeah.
And all you did for 5 hours is just guiding ideation sessions.
Yep.
I think that probably be the best
Yep.
help.
Yep.
Because you can basically ask the tough questions that we wouldn't think about.
Yep.
And go work
Yep.
for like 30 minutes, come back to
Yep.
you. Come back to you. Like that dedicated thing for 5 hours blocks of time is sometimes at least for the team that we have this before.
Understood.
Down, focusing, guiding us.
Understood. I think now that we have narrowed down the group somewhat, we obviously don't need this gigantic room, and maybe we'll switch over to a room where it's much more flexible and we can do this in the next workshop. Yep. Yep. Okay. 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 Great idea. Thanks. Yeah.
I was just going to say I would highly discourage moving into online only, kind of following up on his idea because I had some similar thoughts with that. Part of entrepreneurship, was my understanding of it, is there's a community of entrepreneurs. One of the most beneficial things, especially for like new entrepreneurs, is being able to talk to other like-minded people and their peers, and to go through, shoot polls on each other's ideas, etc. So going on to your get into a small group, have small group time where people with ideas can sit and talk to each other, and not only number one, network between each other in order to meet other people that have this kind of skills and provide support for people who actually want to pursue starting a business, but then go through some of this real time and work through it and talk to each other about, okay, this is what I think, this is what I think it means, and then kind of go through, kind of like that exercise you had on the first day where you got people up there and you said, hey, tell us about your business, right? And people went and talked through it, doing that on a smaller scale so people get more comfort with it.
Yep.
And then be able to grow their ideas in real time with what you're teaching in terms of material.
Understood. And your argument is that trying to duplicate it in an online platform doesn't work. Yep, gotcha. Yep, I agree. Okay, so both of you are saying pretty much similar things. So we'll execute that and forget about this large class and move to a smaller class now. Hopefully, like 75%, 75 people will not show up on the next workshop, by Murphy's Law. That's probably what's going to happen, but we'll deal with that at that time. Yeah. Yeah.
Is it possible to do it starting next week? That'd be very.
That's what I'm gonna do, yeah, yep. Any other questions, comments, suggestions? Yeah, I'm probably like on the spectrum myself too, so I have a tendency to say, why watch me when you can watch a video, or why not do it online instead of in person, and so on and so forth, but I do understand that there's value to face-to-face, yeah. Yeah, you can certainly do it now, and I can go home and rest.
No. I meant like all people can sit there and sitting like 2-3 days.
Yeah. So I don't know what your pain tolerance is to like number of hours. We initially said 1 to 5, giving us ourselves a large window. You probably all have more stamina than I do. I start getting very tired, but you can do this like organically, spontaneously, get together and make use of the remaining time. And then next week, we can try to do this like office hour type organization where I float around and everybody's asking me questions about what they have done at home prior. Yeah. Now, I think there was a question. Hold on one second. Let's take a quick look. Okay, something about initial coin offerings. A link to an event. Do you want to talk about that, Amin?
Oh, it's a documentary that I've been involved in. That tells the history of the solar industry in America. If you guys are interested in solar, how small people have given birth to a really big industry in the States. Check it out. It's on Monday. It's in the P-Market in the venue. It's in the second floor. It's starting 16.
Yeah.
Like I have an idea, but I don't have the technical knowledge to that. So how am I supposed to proceed? Because like now I hire a couple of people, and then I have to say my idea to them. Now they work on that. What if they just
Run
now they have
with
everything,
it.
They don't need me. So what's my
Understood. Do you mind opening it up to the population, or are you worried that these people are going to run with the idea too now?
No.
So why don't we do what they were suggesting, which is, let's have a little discussion about your idea then, and collective mind as to whether we can come up with a solution to this.
Okay.
Maybe you should introduce yourself first. What's your background
Yeah.
and so on?
So I'm Kiran. I'm doing my PhD in electrical engineering. So I'm attending a space course. So there I came up with an idea of like it's not a like it already exists, but it's just not like to make a business out of it. Like servicing satellites in space instead of just sending satellites again and again, because satellites after like 6-7 years they kind of got wasted. So instead of like you sending another new satellite, why not repair them in the space? And so that's the main idea. Since I'm from electrical engineering, I have no idea of like even how the satellite is launched and all this. So now probably what my idea would be like, I propose this idea to couple of like investors get money, hire space people who help those kind of work. And then what after that? Like now they know everything. They have the money. They have the technology. What's my part in that? They can just say, okay, now we know everything. You get out. So
Okay.
what to do in that? Yeah.
Let's hear.
You know anybody personally who could partner with you as a founder who would know that space? I mean, you have a mechanical engineering background, but not. So I'm of the belief, like when I watch the rock, I'm very good talk about domain expertise. That's one of my questions too on the application. So if you aren't that right now, if you know somebody who might have that, that might be a way to do it. Because I feel like certain industries you can go in there without being a domain expert, but with this one, it seems like you might want to be a domain expert or know or the founder to be a domain expert because it's so. I mean, how would you know where to start instead of you about how to, to give feedback with that.
I think like it's not like some super crazy idea, but it's an idea that not a lot of people want to pursue because it's not like a you invest in money and in 2 years you get the money back. It needs a lot of time. So even investors think on that aspect as well. But then like, how am I supposed to trust a person or what's the chance that he won't say that? We know everything and he starts his own thing. Yes, I can.